Well, it's time for the word on Wall Street. Top investors watching your money. Joining me now, Amerivest Securities Head of U.S. Rates, Gregory Farinello, Walser Wealth Management President, Rebecca Walser, and Michael Lee, Strategy Founder, Michael Lee. Guys, good morning to all of you.
Good morning.
Good morning.
Right, Mike Lee, how excited are you? We're going for earnings, but you know what? There's a lot out there to think about. First, you've got futures mixed, obviously. Tech-heavy NASDAQ is higher. You had, obviously a big week on Friday. So the first half of the year has been incredible for the markets, Mike. But now we're going into earnings season. Valuations are through the roof. The expectations are incredibly high for the banks, for a lot of the companies. I've been pouring through the numbers already. And then you've also got the fact that these CEOs are going to have to tell investors how they're going to keep growing, how they're going to keep making money. I think there's a lot of pressure on these companies this round.
Yeah, absolutely, Cheryl. But what I think is not talked about enough, and the big story of earnings since, roughly a year ago, is that analyst estimates have just been way too low. And what historically has happened is analysts come out and they are so overly bullish that analyst estimates steadily come down as the year goes on. Well, since, the third quarter of last year, it's been the opposite. And so we're looking at 65% earnings growth. A week ago, that was 62%, and on March 31st, it was 52%. And earlier this year, this quarter was looking at about 20% earnings growth. So as the year has gone on, the expectations for earnings keeps going higher, which is the direct opposite of the history of sell-side analysts on Wall Street. So we are going to see gangbuster earnings from the banks this week. They're going to absolutely blow the doors off. However, I think the Treasury curve and yields declining is going to what dictates the stock price movements. So I don't think I'd be a buyer of any of those any of those banking stocks. But I do think we're going to see some absolutely blowout numbers from them. What I'm looking at closely is the guidance for the third quarter and the fourth quarter. I expect to see both of those numbers up. So as we sit here and talk about this a month from now, estimates for the third quarter and the fourth quarter will be materially higher. And I think we're going to come in closer to 70% earnings growth for this quarter, which will only lag the fourth quarter of 2009, which was up, I think, 109%. So it's going to be a really spectacular quarter in terms of earnings, and I think when people see that, they're going to feel a lot better about stock price valuations.
Yeah, no, and I think you make a really good point about the banks, because even though you're saying they're going to have strong results, the interest rate environment is an issue for them. And I want to get more into that because, bond yields and interest rates, let's talk about this, Greg.
Sure.
U.S. Treasury yields falling this morning ahead of the June inflation data out tomorrow. There's a big report coming out tomorrow. You've also got, by the way, we've got retail sales on Friday. You've got PPI on Wednesday. I mean, we've got a lot going on as far as the inflation data this week. And then the yields of the 10-year note and the 30-year are dipping this morning at least. You said the biggest story for markets is rates, which kind of coincides with Mike's point about the banks.
Sure. Good morning, Cheryl. No, I think equity investors are clearly watching the rate market. The primary question really, I think, is what are rates signaling in a nutshell? And I certainly think equity investors would rather see a 150 10-year yield here versus a 1% 10-year yield. If you look at real yields, though, in 10-year space, down back close to negative 100 basis points. If that were the case a year ago, I think it was a much different scenario for equity markets back then. But in general, for us, it's generally about, when you see moves like this, it's generally about positions. And I always say in rate markets, really, what's the catalyst, right? So if you go back to the first quarter of 2021, we feel the catalyst was the Georgia runoff election, where we had asymmetry there on the fiscal side, on the monetary side. That's really where you start to see rates take off from there, exposing positions. We had real yields going higher, vaccination levels going higher. There was a real growth story in the market, and we had some problems on the Treasury auction side with some sloppy auctions. In and around 178, we stopped out. What was the catalyst there? Again, it was positions. People were very, very bearish in the marketplace, and we've seen some real money buying. Insurance companies, pension funds, foreign central banks. And the reality is, the Fed is still buying here. We talk a lot about talking about tapering. Now we know they're talking about tapering, but as all this talking is going on, the Fed is still taking 120 billion of securities out of the marketplace each month at the same time time that the Treasury now is spending a lot of the cash that was raised last year into the marketplace. Supply has really come down. So those dynamics have really shifted. The catalyst, I think, for this last move was the June FOMC meeting where the chairman himself made what we think is a prudent pivot by saying, yes, we still think inflation is transitory for the most part, with a big but. And that big but is it's come in much stronger than expected, and it could persevere for longer than we think. So we don't think they've abandoned their framework of this inflation averaging now above 2% for some time. But we do think they are trying to do some risk management around that. And what we saw coming out of that meeting was an extreme move in the yield curve, flatter. If you look at 5-year yields, June 1st relative to now, unchanged. If you look at the forward curves and you look at the long end of the curve, we've had a massive compression. So to me, that's a lot of outpositions in the marketplace on a global basis. The reflation themes of the first quarter into the second quarter, now we're in the third quarter, coming down. In and around 125, which is where we got to last week, it's the 200-day moving average. I think it's a key area to watch. If you look at the peak in yields in 2018 through the bottom in 2020, below that 200-day. If you look at the move higher in yields, 2021, even this move lower, still above that 200-day moving average. So that would be a level we'd watch very closely.
Very interesting, Greg. You had several points that were really big. I want to pick up on your point, though, about inflation and take this to Rebecca, because there's this huge survey from the Wall Street Journal, and economists are saying higher inflation is going to last for several years. They're saying inflation is going to be at 3.2% in Q4 of this year. That's a year-over-year number. And then inflation is going to be at more than 2% for next year and 2023, Rebecca. So those fears, that translate to pressure at the pump. Gas prices are up 40% since January. This goes to the consumer. That could be a problem. What do you say?
I absolutely agree, Cheryl. And, this is not as transitory as the Fed is probably like it wants to acknowledge, because that 3.2% Q4 estimate that's a consensus now of the economists, that's core CPI. So that already excludes volatile food and energy costs, as we know. So when you start to add in the higher cost of increase in food and energy, specifically energy, these are some of the largest gas increases we've seen in decades. And obviously the pipeline shutdown is also a factor of that. It's not just pure inflation. But Cheryl, obviously we cannot act like inflation is transitory when we're like everyone else has said, the Fed is still doing 120 billion purchases per month, 1.3 trillion a year. You add that to the fiscal policy of 3 legislative things centered around coronavirus. So that would be CARES, HEROES, and then ARP that was just passed in March. So you've got $6+ trillion from legislative being pushed into corona recovery, and then you still have the Fed buying at 120 billion per month, and you're going to see inflation if we don't start to balance a pullback. So I agree with the Fed looking at Jackson Hole and saying, should we look at this, because it is not as temporary as they want. No,
and it's coming in faster and hotter than they want, and we're going to get all that data this week. I mean, there's a lot of market moving news that's going to be happening, by the way, on this program. Greg, Rebecca, Michael, guys, thanks so much. Great to see all of you. Great work on Wall Street.
Thank you.
Thanks, Cheryl.
Yeah.